Hello, everyone. This is Mandy Solacek from Premier Marketing. We are super excited today to be talking to you about Thrivent long-term care insurance. With us today, we have Craig Roars. He's going to be educating us on Thrivent's long-term care product. So welcome, Craig. We're happy to have you here. But before I let Craig take it away, just so our audience knows, we are going to have time for a question and answer at the end. So you will see in our webinar program here, there is a question box available to you. Please utilize that, ask questions. We will go through them at the end and be able to ask Craig upfront any questions that you have about the product and things that he can answer. If you're also experiencing any audio issues or something's going on, please, you can use the questions box and I can communicate with you that way as well. So with that being said, Craig, are you ready to take it away?
I am. Thank you so much, Mandy, and thank you everyone for joining us today. I hope I've got some really great, exciting news for you today about a product that's going to be fairly new for most of you, and it's only really been in third-party distribution now for about a year. So it's still really new to the market outside of Thrivent's captive distribution. So a lot of people, and especially consumers, they're not aware yet of this solution. And as you know, the market has really changed just in the past few months, even where we've seen carriers like Mass Mutual and Transamerica exit from the traditional space. And then there's, questions that people have about some of the older carriers that have been around for quite a while, like Genworth. What is the future of Genworth? People have all kinds of questions. And so to me, there's like no better, more exciting time to be offering a solution like Thrivent, just because as you're going to hear, we offer a really stable, secure, benefit-rich solution that I think a lot of people are really going to find refreshing, both as producers and as consumers. And I'm going to cover quite a bit of ground, I believe, today. So I'll make sure to provide the team at Premier with follow-up, any of the key pieces that I might reference on this call today. But you really do have a unique advantage now in being able to offer Thrivent to your clients, as the strength and stability of this carrier really come at a time when the news is filled with questions about some of those stock-owned carriers, as I just mentioned. We are not a stock-owned carrier. People are concerned about, the viability of some of these companies, but you don't have to be concerned about something like that with Thrivent. You are now going to be able to offer what I think is the most benefit-rich standalone solution on the market that just happens to be backed by the strength and stability of the country's largest fraternal insurer. So I'll start with a little of the Thrivent story so you understand kind of where we've been and where we're going, a little of our history in long-term care, and then really dive into our key differentiators in the marketplace. First off, who is Thrivent? For those not familiar with us, we are the world's largest fraternal organization. And for those not really familiar with what a fraternal is, it's a not-for-profit organization where all of the members share a common bond. And so with Thrivent, that common bond is that our members or clients, policyholders, are Christian. So you may know that we used to be called Thrivent Financial for Lutherans, but we actually opened up membership to more broadly accept all Christians back in 2014. But a simpler way to think of a fraternal like Thrivent is that we're more like a financial cooperative where all of the members or policyholders are owners of the company. So as such, we are not a stock company. And again, that's very important in that we are not beholden to Wall Street interest and returns every 90 days like some of those stock carriers were. So we're more like a mutual company in that regard. But unlike a mutual, for our not-for-profit tax-exempt fraternal status that we have, Thrivent is required by law to give back to our communities. So as such, you will see that we are the country's largest supporter of Habitat for Humanity. And you've very likely seen people out in your community working on various service projects wearing Thrivent's Live Generously t-shirts. All of those projects are funded in some way by some of those Thrivent fraternal dollars that we're putting back into the community. And I'll share with you how to discuss Thrivent's common bond requirement a little closer to the end of the presentation. I'm not going to be dodging it throughout. People tend to ask the question, how do I ask the Christian question? Throughout the presentation, it's not that I want to dodge it. I want it to be one of the last things that you hear, so it's very clear how you can best position Thrivent as an option. So as a carrier, our ratings are hard to beat. We are A++ rated by AM Best. We have a Comdex of 99, and we are the only one of the top 3 highest rated carriers that is available to independent brokers. New York Life and Northwestern Mutual have high ratings similar to ours, but they are, as you know, captive distribution only. So you might be wondering, well, is Thrivent new to long-term care? Well, that's a yes and no answer to that one. So Thrivent began as 2 separate fraternals. Those of you that have been doing long-term care for a while might know this, but we began as Aid Association for Lutherans, AAL, and Lutheran Brotherhood. And both of those fraternals began selling long-term care back in 1987. The 2 companies merged in 2001, at which point they formed Thrivent Financial. So at that point, Thrivent offered some other carriers long-term care solutions for a few years as we were busy getting all of our other product lines off of the ground, our life, our annuities, things like that. But because Thrivent so firmly believes in solving this problem for our members, we re-entered the market with our own product in 2012. And we are now on our 2nd generation of product, this one being priced and launched in mid-2016. So our pricing is still pretty fresh. So if you think about it, Thrivent, as you can see here on the screen, we have the benefit of over 30 years of worldview in long-term care solutions being provided to our members, but perhaps we don't have some of that baggage that comes with some of the missteps that other carriers made on things like pricing and underwriting and other assumptions that carriers made in the late 90s and early 2000s. AAL was formed back in 1902 and Lutheran Brotherhood began back in 1917. So we're not a new company. You're actually working with an insurer whose roots go back over 100 years. One of the first things I like to address because people have concerns about it in regards to some of those older carriers is, well, have there been any rate increases on any of your business? And yes, there has been one rate increase back in 2004, as you see here on the screen, but it was on the old AAL and Lutheran Brotherhood blocks of business. This was one time back in 2004. And as you can see here on the screen, these are much smaller than the rate increases that you've seen on some of the business sold by stock-owned companies during those same time frames. Some of them have high double-digit, even triple-digit increases that you've seen. And to be crystal clear, there have been no increases on the Thrivent branded products that have been available since 2012. And our actuary and our head of product, when I spoke to them the other day about it, they feel very secure about our current pricing and our future viability with our products. And then a little bit more before we dive into some of our product basics, I'd just like to let you know who we work with, how we work. For health pre-qualification, underwriting, and for our claims processing, we have teamed with one of the most experienced partners that you're going to find out there. LTC Group, LTCi, you might know them as. You're probably very familiar with them if you're doing any long-term care, as they are used by many of the other leading carriers, both for traditional and linked benefits, as part of their process, whether it's their underwriting, whether it's their claims, whether it's the whole ball of wax. LTC Group is one of the most experienced partners that we could find. And a great thing for us at Thrivent, since we are based in Minneapolis, they are pretty much LTC Group. They're in one of the suburbs of the Twin Cities. So they are a great partner that we have really great access and communications with. They're right in our backyard. So on the screen now, you'll see a snapshot. I just kind of want to give you a glimpse of where the marketplace currently is. So 10 years ago, this list was dominated by stock companies such as Genworth and John Hancock, among some of the others on the screen. And at the peak, the industry was insuring about 250,000 lives a year. Now, if you take a look at last year's end of year LIMRA numbers, these just came out about a month ago. Thrivent at the end of 2020 was the 6th largest traditional long-term care insurer. Please note that the number 5 carrier, Transamerica, exited long-term care sales on March 31st of this year, And Mass Mutual, last year's #7 carrier, also left the market at the end of 2020. So a key thing I just want to stress here is many of the top carriers now, as you see, are mutuals or fraternals. And we've seen this shift with consumers looking for products that are backed by the strength and stability that these type of insurers provide. And it's something that you'll see with some of the linked benefit carriers too. Most of them are for mutuals as well. So people are looking for carriers that are going to be able to stand the test of time. So real quick on this slide, I'm going to share some of the key differentiators of Thrivent's product to some of the others in the industry. I'll go into a little bit more detail on some of these on some subsequent slides here, but I just like to give you a real sense of where some of our spots are going to be. So first off, our issue ages are 18 to 79. As you might know, many carriers now limit this to ages 40 to 75, so you're going to be able to help a lot more people solve for this issue. We have a 5-year rate guarantee built in. Most carriers no longer offer rate guarantees. Our elimination period has a built-in shortcut of 1 day of care in a week, satisfying that entire week towards the elimination period. So as opposed to some carriers who have a true service day, 1 = 1, we have a built-in shortcut here. We can even make that shorter with a rider that I'll discuss here in a bit. And then this is one of the things I love most about our product. We offer really robust features. We can go all the way up to an 8-year benefit. We can go up to $15,000 a month. So we can design some really robust plans for the people that are looking for that type of coverage. We've also got some great options for inflation. We offer one of the few 10 pays that you're going to find on the standalone side. And finally, we have a whole variety of riders that we can really use to customize a plan for someone. So our contract is built on a reimbursement model. And as you'd expect in a modern traditional long-term care policy, Thrivent's going to cover services and care in a variety of settings, including home care, residential facility care, and adult day care. Our contract is intended to be federally tax qualified, and it's also been filed for partnership in most states. The product is going to be available in all states except for the state of New York. And one of the most frequent questions I get is, will we be filing a product there anytime soon? And unfortunately, even though there's a huge opportunity for Thrivent there, we are not looking to file a product in New York at this time. So now let's break our conversation up into built-in benefits, and then we'll tackle some of the optional riders that you can add to really build on your policy. So first off, we have a built-in waiver of premium, where once the elimination period is satisfied, all future premiums are going to be waived. Also, if a couple applies together and they have shared care with us, there's going to be a double waiver of premium built in, where we will waive the premium for both individuals, even if only one of them is receiving benefits. I really like our care coordinator services. Actually, I love care coordinator services in general. And that's because when it comes to claim time, this is one of the least talked about features when you're selling long-term care usually, but I think it's one of the most beneficial for the family, because when you're in crisis mode and you're panicking, you don't know where to turn for anything, care coordinator services can literally be a lifesaver for the caregivers, because they are going to be your resource to help find the local care, coordinate schedules, all those kind of things. And the great thing about it with Thrivent is you don't need to use our care coordinator services in order to tap any of your policy. But the expenses for the care coordinator services are not going to be taken out of your benefit pool. These are actually covered separately by Thrivent, because we so firmly believe in the value that these type of services bring to families at the time of claim. We offer bed reservation in a facility for up to 60 days per calendar year. To help with emerging services and technologies, we have an alternate care provision built into the policy. And then we have a contingent non-forfeiture benefit in the event of a substantial premium increase, like some of those that I mentioned other carriers have had over the years. And I will get a printout of this whole deck to the team over there at Premier to share with everyone. So if you're like me and you're on a webinar and you're frantically scribbling things down, please know we will provide you a PDF with all of this. Next, we have what I call, or what Thrivent calls, ancillary benefits. These are the things built into every contract. They're things like respite care, equipment and home modification, caregiver training, and an international care benefit. Most of these are geared towards helping keep you at home as long as possible. Now, each of these benefits is going to be equal to 2 times whatever your maximum monthly benefit is. So it's not 2 times for all of this, it's each one of these 4 things is going to be equivalent to 2 months worth of benefit. And the reason I'm spending a moment on this is when we get down to international care. So with the equivalent of 2 months of benefit, this might be a little less than what you'll find with some other carriers. And I'd just like to be crystal clear and truthful about our product. If international care is a primary concern for your clients, we might not be the best fit. So another area that we differentiate is in some of our basic building blocks. So first off, elimination period. Our elimination period, you can choose 30, 90, or 180 days. And again, instead of the actual service days that some plans offer with Thrivent, if you just have 1 day of care in a week, it's going to satisfy that entire week towards the elimination period. It only needs to be satisfied once while your contract is in force. And then again, we can do some really robust plan design. We can do monthly benefits from $1,500 all the way up to $15,000 a month in $100 increments. Most other carriers will stop at $9,000 or $10,000 a month. We can go up to $15,000 a month. And then while other insurers, many of them max out at maybe a 5-year or 6-year benefit, we can do 2, 3, 4, 5, and 8-year benefits. Then if you take our 8-year benefit with a couple, each having an 8-year benefit, and you add shared care to it, you actually will end up with a 16-year shared pool, what I like to call the next best thing to an unlimited benefit these days. So we have 2 types of inflation growth to grow this policy, and I'll start with the most popular and the one that's going to be most familiar to you. Our annual increase benefits are going to be your traditional compounding inflation. So we offer 1, 2, 3, and 5% compound inflation. And I'll let you know here that due to another carrier's price refreshes in the past year, we are now very competitive when you look at 3% compound inflation in particular. Another thing to note is our 1 and 2% compound inflations are going to be partnership qualified in over 20 states. So here, we do have another advantage over some other carriers in that we have the 1 and 2% available, where some of them offer nothing less than a 3% compound for partnership. Our second option is a really unique one. So we offer something that's called a flexible increase benefit. So this is an inflation buy-up option. Now here, every year, you will receive an offer to buy up 5% compounded inflation at your attained age. You're not going to have any evidence of insurability. And this is going to happen automatically unless you opt out that year. So the premiums will increase with each one of those little offers that you get, each little 5% compound inflation offer. And each of those is going to be based on your age at the time of the increase. So if you buy at age 50 and you get that first offer at 51, you're going to have a little 5% addition added at and priced at age 51 rates, and the same at age 52. How does this work though if people decline some of these? Okay, well, if 3 consecutive offers are declined, at that point, no future increase offers will be extended. However, the rider is going to remain on your contract since the insured will be eligible for automatic benefit increases that will turn back on at the time of claim. And you'll actually see how that plays out here on the next slide. I like to use this to explain how this whole feature works. In this scenario, we have a client named Mary. She's 50 years old and she buys a Thrivent contract, and she chooses the flexible increase benefit because this rider was going to help her manage her budget, since the premium increases were going to be dependent on her choice on whether she accepted or declined an offer. And her initial goal when she met with her financial planner was to accept increases whenever she could until her benefit amount reached at least $15,000 a month. So over the next 20 years, starting at the left side of the slide, at age 50. Over the next 20 years, Mary accepts 13 annual increase offers, they're in the red, and she declines 7, they're in the dark gray. However, as you can see, she didn't decline the offer in 3 consecutive years for a while, which meant her flexible increase benefit continued to be offered each year. And again, she tried to take this whenever she could so she could grow her benefit. Jump to the middle of the screen, you see that she reaches age 70. At this point, she revisits her policy, and she decides at this point her maximum monthly benefit has grown to a $15,000 a month pool, and she still thinks at this time that it's going to be adequate to meet her future needs. So at this point, she declines all future increases. That's why you see it go to the 3 dark gray bars in a row. And then it transitions at that point to the light gray because she is now no longer offered any of those future increases. Flash forward again to age 80. At this point, unfortunately, Mary's health goes downhill and she needs to go on claim. At this point, the FIB, the Flexible Increase Benefit Rider, automatically kicks back in, increasing her maximum monthly benefit and whatever is left in her benefit pool by 5% compounded annually, and it's going to continue to do so each year that she is receiving care. That's why you see it ticking up in red again at the end of the screen. Now, the great thing here is she doesn't have to worry about paying premiums on any of that, since a waiver of premium is a standard benefit included with her insurance. And our illustration software, it can really show you how the pricing could play out based on somebody's desires. Like if somebody wants to just take this every other year or every third year or what have you. And that becomes important in when you look at this as a partnership solution. So the FIB can be partnership qualified dependent on your age in 26 states, as long as you meet that state's buy-up requirements. And I will provide a full list of partnership requirements for all of the states as a follow-up to this call. But one example I give is I live in Minnesota. Here, someone has to accept all FIB offers up through age 75. So using the example here on the screen, Mary's policy would have lost partnership qualification after she declined that first offer at age 57. So it's really important to, if you're going to show this option, to be able to explain to somebody what they would need to do and also how this works, just because this is in the brochures and everything. Even if you don't sell this option yourself, it's good to understand how it works so you can explain it to somebody. It's very popular with Thrivent's career agents because this works best for those who have annual reviews with your clients, because you want to make sure that someone understands the need to continue buying up, either to maintain that partnership status or just to keep growing their benefits. So when you look at it, this works best for those people who do have those annual reviews. For most producers, we are seeing the vast majority of the independent distribution opts for our regular 1, 2, 3, and 5% compounding inflations. It's just simpler for them, and it's simpler for most clients as well. Now let's take a look at some of our optional riders. And if I mention some cost percentages here, note that these are ballparks. They can be impacted by various things like elimination period, marital status, risk class, things like that. But you know, when you're out talking to people, it's good to have a sense of what something is going to cost. You know, you want to use the actual illustration software for exact pricing, but I will throw you some ballpark numbers as we continue. So first off, we have an additional cash benefit rider. This is going to give you that flexibility to pay for some of those services not typically covered, including care from family members. Now, you know, or you notice I said additional cash benefit rider. So unlike some other carriers where they have maybe a built-in cash alternative of maybe in any given month you can receive 100% reimbursement or 25% cash, with Thrivent, if you add this rider, you can actually enjoy the best of both worlds. So by adding this rider, you will still be able to receive your full 100% reimbursement in any given month, but you will receive an additional cash benefit on top of that. And that is going to be based on where you are receiving care. So if you receive care at home, you will get an additional 15% of whatever your maximum monthly benefit is. Or if you're receiving care in a facility, it's going to be equal to 10% of whatever your maximum monthly benefit is. And you can see in the example on the screen, if you have a $5,000 a month benefit for home care, you'd receive $5,000 up to that amount. but you can also receive, if you're at home, another $750 on top of that, paid as cash that you can use to pay for some of those incidental expenses or informal care from a family member or friend. And the cost of this rider, it runs about 16%. So your clients don't want to use it or lose it. We have a couple of ways to address that. We offer a non-forfeiture rider, where if someone wishes to terminate their coverage after 3 years, they will have a benefit equal to whatever they've paid in premiums up to that point. The cost of that rider runs about 8%. We also have a return of premium upon death rider that's going to return any premiums paid, minus claims, of course, to the insured's estate. Now, the rider has to be in force for 10 years before death occurs in order for them to be eligible for payment. And because of that stipulation, I believe it is one of the more affordable return of premium options that you're going to find out there. And the cost of the return of premium, this one does vary with issue age, but a couple of examples, it runs 25% for someone age 50 to 49% for someone age 65. We have a shared care option that's going to link together two individual contracts. So again, it's not a third pool concept like some others might offer, but two pools that are linked together. What happens if one spouse uses all of the healthy spouse's benefit? Well, if that happens, the healthy spouse will still have an option to buy a 2-year benefit for his or her use only. It will be priced at their current age. It's going to be available for them up through age 85, but they don't have to have any evidence of insurability. And the reason Thrivent does this is we realize that, you know, a lot of people aren't going to go on claim until they're in their late 70s, early 80s, and we don't want somebody to burn through perhaps 2 3-year benefits, a 6-year total, and you know, their healthy spouse not having anything. So we'll at least give them the opportunity to get a 2-year benefit just for their own use. When one spouse dies, the survivor's contract is going to be increased by whatever was left in the other's benefit pool. And the cost of the shared care rider is going to be dropped from the policies at that point, while the spousal discount remains in place for the survivor. Now, shared care, this one does vary with benefit multiplier, but a couple of examples. It runs about 25% for linking together 2 3-year plans, to 16% to link together 2 5-year plans. Another benefit for couples is we have a survivorship rider. It's fairly standard to what you see others offer, but this one, it runs about an additional 10%. We can make for a 0-day for home care with our waiver of elimination period rider. So as I mentioned, we already have a built-in shortcut with the 1 = 7, but we can make for a 0-day for home care. And our advantage here is that while others may charge as much as 10% for 0-day, ours runs about 7% additional premium. Thrivent is one of the only traditional carriers offering a 10-pay option. Here, all premiums are going to be paid up in 10 equal payments. And there is going to be a reduction in commission for you, the agent. One thing to notice or to note here is if you have 3 or more 10 pays that are going to be submitted at the same time, for example, a small family-owned business maybe where everyone's applying together, and I use that example of family-owned business because in that instance, you would know whether everybody's going to meet that common bond of Christianity requirement. If you have those kind of instances, please work with your sales team, as we do have a pre-approval that is required for 3 or more 10 pays applying together. And that's just because Thrivent doesn't want to become a 10-pay only carrier. They want to keep a balanced risk to, you know, remain stable for all of their policyholders far into the future. But if you have a single person or maybe a couple applying for 10 pays, those do not need that pre-authorization. It's just going to be anytime you have 3 or more people applying at the same time together. Discounts. This is another area where we differ. So first off, we have a 10% health discount, our preferred health discount. And the great thing here too is in our underwriting guide, you'll see we have very clear-cut guidelines around what our preferred health guidelines are going to be. So you just check out our underwriting guide. There's one page in there that lists everything that is going to be required for preferred health discounts. And then we also have a couples discount. Again, this is an area where we differentiate. We can be a bit more generous than some other carriers. We offer 20% if both people are applying and approved, or a 5% discount if just one is applying or approved. And this, again, is another area where when a leading carrier made some rate refreshes late last year, this is an area where they changed. They really reduced their couples discount. So who qualifies for that couples discount? It's going to be any married couples, any civil unions, domestic partnerships. To be crystal clear, that does include same-sex partners. It's also two individuals who are living together for at least 3 years in a committed relationship as partners or family members and who are committed to sharing expenses. They are not married, and if related, they have to belong to the same generation. So siblings or cousins, things like that. Often here in the Midwest anyway, we often see it with maybe two bachelor farmer brothers living together on the family homestead after mom and dad retire down to Florida, because that is state law here in Minnesota. If you retire, you have to retire to usually around the Naples, Florida area. But those two brothers could apply for and receive the couple's discount because they are living together, sharing expenses, they are not married, and they are of the same generation. Not only could they qualify for the couple's discount, they could actually apply for and receive the shared care benefit as well. So let's now talk about some sweet spots. Couples pricing. Especially because some of the other carriers have reduced their couples discount in the past year. Because it's priced to only pay out if in force for 10 or more years, that return of premium can be a lot more affordable. Also, as I said, our 0-day home care is going to be one of the more affordable ones you'll see out there. We're a great fit for younger couples, high net worth clients. If you work with affluent people, they appreciate a product like Thrivent, and I'll tell you why. When they do anything in life, they usually aren't looking for whatever is the cheapest. They want the best of something. And so they're willing to pay a little bit more, or they want to have the best. So again, with that ability to go up to 8 years, the $15,000 a month, the shared care, that additional cash benefit rider, all the things that we can do here, we can design some really robust plans here. We've always been competitive when looking at 5-year benefits, even more so given these rate refreshes in the past year. Again, more issue ages, that 10-pay option, anytime carrier strength is a consideration for somebody. And then there's going to be a lot of underwriting in other niches. And here I actually have to go off screen here for a little bit because some of the things I'm going to relay now are things, because there are variables around them, I cannot get them through get them through compliance easily on a slide, but I like to share these with people just so you know some of the really great sweet spots that we've got. So first off, some health and underwriting areas that Thrivent is a good consideration. First and foremost, you do not need to have seen a doctor in the past 24 months in order to apply. Some other carriers, they require maybe a doctor visit in the past 12 or 24 months to even consider you. Thrivent does not. Now, that being said, if you have not seen a doctor in the past 2 years, you cannot be considered for preferred health, but you can still at least apply for standard rates. That preferred health discount, again, is 10%, and according to last year's Broker World Long-Term Care Survey, Thrivent issues about 4% more cases at preferred than our leading competitor. We'll look at some cases with a history of severe anxiety or depression based on stability. We'll also look at some conditions like arthritis, AFib, or heart bypass, again, depending on stability and any residual effects they may have. We'll look at a variety of cancers based on stage, treatment, and stability. One I like to throw out there is somebody recovered and treatment-free for stage 4 Hodgkin's. I know that's a automatic decline with some carriers. We will take a look at them. Let's see, type 2 diabetes. Our A1C will go up to 8.5. Now with Thrivent, we are looking for stability of meds or insulin. So we don't list a maximum number of units of insulin in the underwriting guide. So if you look there, you're not going to see a number. So if insulin is being used, you want to discuss that with our pre-qualification line at LTC Group. Another spot talking about that LTC Group, Thrivent won't automatically decline someone just based on other carriers' declines. So we will take a look at some, and I've seen some cases get issued with us that got declined elsewhere. Now, that being said, we're not going to just take any decline. So any past decline, take whatever information and bounce that off of the underwriters over at LTC Group. See if they'll even take a look at that app, but we have seen some cases fit. Common question we get is, does Thrivent look at family history in our underwriting? We do not look at family history with the exception of early onset Alzheimer's dementia. And there we have the following guidelines. What we define early onset Alzheimer's dementia as is both parents being diagnosed with Alzheimer's prior to age 65, or there's a death from Alzheimer's prior to age 70, or a parent plus one additional close relative, maybe a sibling, aunt, uncle, or grandparent on the side of that affected parent with early onset Alzheimer's. So at age equal to or less than 59, whether or not the member showed any symptoms of cognitive disorder, if both parents were either diagnosed with Alzheimer's prior to age 65 or died, they would be ineligible to apply for coverage. But again, if there is that history, contact the underwriters at LTC Group and pre-qualify the health. Talking about underwriting guidelines, I'm actually going to switch from my slideshow view, so hopefully you'll be able to see this here. Underwriting guidelines. This is an area where we saw a lot of growth last year. So last year, as you may know, when the pandemic really hit, some of the carriers stopped issuing over certain ages because of the requirements for face-to-face assessments. They were concerned that they would not be able to get somebody out to see someone. So some of them really dialed it back. They weren't issuing over maybe age 65. Thrivent continued to issue policies that entire time. So we only require a face-to-face assessment for those 60 or older if you have not seen a doctor in the past 24 months. Otherwise, it's going to be ages over 69 are going to have that automatically required face-to-face assessment. But otherwise, if you're under 70, you're only going to need it if you haven't seen a doctor in the past 24 months. All right, now I gotta, oops, that was not what I was trying to do. Sorry about that. Trying to juggle too many things here on my screen. And I keep hitting the wrong button. So Mandy, I'll just see if you can do a really clever edit of all this later on.
You know, we have
here.
some talented gals here, and I'm
No,
sure
my
they can
apologies.
crop out whatever you want. Oh, no worry, Craig. You're
Well,
handling the presentation mode far better than I would.
well, as long as I'm off of the slides, let me jump to one other thing. So as I was mentioning, we're really competitive in some areas now. Just some quick numbers to show you, and this is comparing against the leading carrier out there, Mutual of Omaha, due to their rate refreshes. And this is comparing everything as apples to apples as I could. And this is looking at their less costly option, their secure solution product, not the custom solution. But as you can see here, at most ages for married couples, we are going to be quite a bit more affordable. Single males, again, it's going to be substantial difference. And again, this is without showing the custom solutions. So I know a lot of people show a custom solution for couples in particular, but even if you're looking at a secure solution for singles, in most instances, single males are going to be less expensive with Thrivent, and the same with single females. So as long as I was off of my regular presentation, I wanted to be able to show you some of those numbers. Let's see if I can do it right this time. There we go. All right. So a few other things to look at with Thrivent. Since we don't have nationwide, since we have nationwide pricing, not state-specific pricing, we can be really competitive in some states like Florida or California, where some others may have some state-specific rates. If you sell in the state of Indiana, we offer the only partnership policies in that state available to independent brokers right now. A cool thing about Thrivent, this is one you want to take a look at our producer guide with, but while most carriers let you decrease benefits, how many of them will actually let you increase or add benefits after issue? We do a lot of different things there where somebody can add riders. They can change their inflation from, say, a 3% compound up to a 5%, things like that. After issue, it's going to require evidence of insurability and it's going to have an additional cost, but most carriers don't let you add benefits. With Thrivent, you can do that, and it might save you from maybe having to do a wrapper policy for somebody that realizes maybe they didn't buy enough coverage at one point. Some other frequently asked questions, good things to know before selling Thrivent. Getting appointed. Thrivent currently only requires pre-appointments in 3 states, Georgia, Pennsylvania, and Wisconsin. Paper apps and appointments may be processed simultaneously if you are in any of those just-in-time states, though. But one thing to note is if you want to use the e-app, an agent does have to be appointed prior to submitting their first e-app. You have to have a Thrivent producer code. So if you're thinking of writing Thrivent, I would suggest you get appointed sooner than later. We also have 4 states that require a fraternal license to sell the product. Those states are Connecticut, Delaware, Massachusetts, and New Mexico. So if you sell in those 4 states, you really just need to add an additional line of authority to your current license, pay a nominal fee, and submit a form to the state, and you will then have this fraternal license. I get asked, what are the rules around saving age? We can save age for up to 30 days after somebody's birthday, but that application actually has to be submitted to the home office within those 30 days as well. I get asked, do you allow people to pre-qualify health with Thrivent? Yes, you can contact the underwriters at LTC Group. The phone line tends to have faster response than email, but for the phone option, you do have to have a producer code. We get asked, why is there a W-9 form in the paper app? And the reason for that is it's the only spot to capture a social security number on the application. That W-9 is not submitted to the IRS. And then this is a big thing right now. I don't know if any of you sell in the state of Washington. For those that do, you're probably very familiar with the Washington Long-Term Care Trust Act that is out there, where people are going to have to pay a mandatory payroll tax starting at the beginning of next year. That's going to give them a really minimal long-term care policy. I believe it's $100 a day, 1 year worth of benefit, and yet to be determined inflation number based on the CPI in the state, I believe. But there's an opportunity right now. If you own long-term care and you're in the state of Washington, you can opt out of that payroll tax. So we've seen a lot of interest out there. It's just a surge right now. And the key thing in Washington is Thrivent is going to be a go-to for you out there, in that we will allow premium with application. Not all other carriers do that. We do not require pre-appointment in that state. I know another leading carrier does require that. And what we'll allow is, if requested, the date of the application can be the effective date of the policy. And what does that mean to you? there's a deadline for people to own coverage, and that deadline to opt out of that mandatory tax is you have to own coverage before November 1st. So with other carriers, you have to factor in if they're going off the actual issue date and they don't allow the application date to be the effective date of the policy, you have to factor in that you have to write this policy probably 2 months before that deadline. Not with Thrivent. With Thrivent, as long as you take the app, you submit premium with the application and it's received before November 1st, you could do this on the last day of October and ask for the effective date of the policy to be the same as the application date. So we're going to be able to write some of these policies right up to that deadline. And I'm just going to jump forward a few slides here. As I mentioned, our FIB inflation is something you can really demonstrate in our quote software. So if you have really analytical people that you work with, engineers maybe, you can really show them just about any way that this might play out. You could do every other year, every third year. There's a customized option down at the bottom of that drop down you see on the screen. You can really choose just the certain ages they want to buy at. But you can show them what effect that will have on their premiums, their monthly benefit amount, and their available benefit. So how does Thrivent compete on price? I already showed you a few slides, but I just wanted to show you Thrivent against some of the biggest names in the industry. So here I ran only A+ or higher rated insurers. And as you can see, we have 2 that are only available to captive distribution, Northwestern Mutual and New York Life, and then 2 that are available to independent producers, Mutual of Omaha and Thrivent. All things being equal, what I also did with Thrivent Mutual of Omaha is I added 0-day for home care because I know it's not available with the others, and I added shared benefit because it's not available again with all the other carriers. So when looking at just the carrier strength, not only is Thrivent competitive, but you're actually getting quite a bit more bang for the buck in many instances.
Hey, Craig,
again,
just sorry
yes?
to interrupt you. Can you drag your GoToWebinar,
Oh,
your
sorry.
little toggle screen, just up a little bit so that way they can see? There you go. Perfect. Thank you so much.
So they can see how much higher price Northwestern Mutual is? Perfect. All right, let's see here. Oh, as promised. Now, the #1 question on Thrivent is, what is the Christian requirement and how do I talk about this? So again, Thrivent is a fraternal organization whose common bond is that we serve Christians. So as such, there is one and only one Christian-related question on the application. And it's one of the very first questions you're going to see so that people don't get all the way through before knowing whether they qualify or not. And the question itself is very simple. It just says, select one of the following. I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. That's it. You might see there is an additional optional question for a church name, but it is not required, and if completed, it's not looked into. I believe they are just looking at it as something where, as a Thrivent member, they offer Thrivent membership meetings to talk about different programs and stuff like that. So they might look at it as a marketing thing, but we tell people you do not have to complete that. But people see the church name thing and they say, okay, well, is church attendance a requirement? No, it is not. Because of how you see Thrivent has worded that question, you can actually have people from mixed faith marriages or even people without faith get coverage with Thrivent as long as they are married to a Christian living out their faith. And if you're wondering what this might actually look like in your own book of business, with 70% of the American population self-identifying as Christian, odds are many of your clients would be eligible to apply for Thrivent coverage. So don't be afraid of bringing this up as an option. But here's how to position this as an option with your clients, especially if you're not sure of somebody's faith. Maybe you sell to internet leads that you get through your website. You've never met this person up until that first phone call. Here's an approach we've been using for the past 5 years. It really tees up Thrivent by putting your client in charge of whether you can proceed in the conversation or not. So you just say something along the lines of what's on the screen here, something like, I've got a few different solutions that we can discuss today. One that I think might be a really good fit for you is with a fraternal benefit organization called Thrivent. So They are a top-rated financial services organization that was formed to serve Christians. So I don't know if that's an option for you. And if not, you know what, that's okay, because I've got a few other solutions that we can discuss. And at that point, stop talking, because your client will let you know whether you can proceed, or they'll say, you know what, that's not for me. What else do you have? And you just pivot to another solution. Nobody's bothered by it. Nobody's offended. It helps you put them in charge of the conversation. So on a related note, while you do have to be Christian or married to one to buy Thrivent's product, you do not have to be Christian to sell Thrivent's long-term care product. So as I started out with, there's no better time, I think, than right now to be adding Thrivent as an option. We are really positioned to be here for the long term. To get started with anything Thrivent, whether it's getting appointed, getting a quote, what have you, contact that experienced team that you have over there at Premier Marketing. I've worked with several of their sales desk, and they know so much about long-term care. They know where we fit against the other leaders out there. They can really give you some great direction on if Thrivent's going to be a good fit. So I hope I've shared a great story with you today. If you have questions now, Mandy, anything that I can answer that anyone has submitted?
Yeah, well, thank you, Craig. That was awesome. You went into grave detail, like awesome detail. I'm super excited for everyone to get the recording. So many have asked me if they're going to get the recording, because you've given such great info. So yes, to everyone who is still tuned in, we still have quite a few people on the call. I know a lot of people are waiting for that recording too, but you will get a copy of our webinar today, a recording of it, along with the marketing materials that we'll be sending out. Craig's going to provide us with some PDFs, as he's mentioned. So we did have a couple questions. A few of them that came in, you did actually touch on them eventually on. So I will go back to a couple of them though. Someone did ask, can you address build, like a height and weight chart, as far as Thrivent's underwriting approach? So I'm guessing they're probably inquiring as far as maybe what it looks like with your rates go, like the rate classes.
Right. So we do have a build chart in our underwriting guide, and I will be the first to admit it's not the easiest one to use because it is not based on your simple height and weight. It's built on a BMI. So there is a little bit of math that has to be done to use it. But I would say we are probably fairly standard, in line with most of the other traditional carriers out there on height and weight. We don't have like any niches for somebody that's you know too short for their weight, or however you want to call it. But yeah, it's in our underwriting guide. There is a formula that you use to get the BMI if they don't know it, or you don't have it handy. There's also a ton of BMI calculators online that I use. So
Awesome. And we did have a couple of people ask questions about the underwriting guide. I did reach out to a couple of you that inquired about it. Just know that if you have questions about that, we are happy to email you a copy of that to our agents. Go over that with you if you have any questions about that height, weight, and chart. We're happy to answer any questions for you guys as well.
And
So
we are
another
working
question.
with
Oops, go ahead.
the underwriters on changing to a more traditional height and weight chart as well, instead
Gotcha.
of,
Oh,
yeah,
okay. Well,
we're
that
moving
that
towards that.
kind of that kind of leads into my other question here, Craig. So someone did ask, um, is there going to be any enhancements or adjustments regarding around the product in the near future?
No, our head of product and our head actuary, I spoke to them just last week on this because we get asked this all the time. They are staying the course at least through this year on product, and probably into next year, because our real focus on product development is going to be probably in the fourth quarter. Thrivent will launch a linked benefit solution. So we'll actually be one of the few carriers that has both options on one platform, where you can either go with a life linked a full linked policy, comparable to your money guards and things like that out there, or a traditional. So we're going to be able to offer somebody two great choices with one great insurer.
Gotcha.
And that's where our focus has been. So yeah, we're not looking at
Right.
any other products or changes to product in the near future here.
Awesome. Okay. Another one was, how can we run our own quote illustrations?
I believe the team over at Premier can connect you with their iGo platform if you do like running your own quotes. You can run those. The great thing about the iGo platform is if you run the quotes there, it will actually pre-populate a lot of the application based on what you enter there. So it'll give you a big shortcut if you're doing the e-app. It's also available in StratDecision for anybody that uses that, but also the team at Premier is phenomenal at providing quote support as well.
Yes, we can certainly assist you guys. It is available in the iGo e-app as part of it, and it is handy. It does pre-fill that application for you. The illustration is hand in hand with the e-app in there, but we can also assist you with other quoting software, and if you'd like us to run quotes for you, we're happy to do that also. So let's see. Someone inquired, typically how long is it for underwriting decisions?
That has been varying based on COVID over the last year, but we're seeing most of the policies are probably under 60 days, depending on age, whatever medical information they get, things like that.
Okay, and then I
I would
think,
say probably, yeah, six weeks ish.
okay. And then I think you touched on this, but someone asked, with the 10 pay option, are premiums guaranteed?
They are not, but we haven't seen any carriers that I can think of that have had a rate increase really impact those 10 pays. And again, here's the thing with Thrivent is because we are member owned, the very last thing we want to do is raise rates on our members, the people that own the company. So that is going to be one of the last things that we do. So it's almost a rate guarantee without it being an official rate guarantee is how I think of it with my own Thrivent policy, is that as a policy holder, a member of the company, an owner of the company wants to do its best to take care of me. We're the whole reason they exist.
Awesome. Okay, well, that was what we had for questions. So Craig, I thank you so much for coming today, and I love that you put our information up here on your last slide here. So everyone, thank you so much for coming today. Please, if you have any questions, do give us a call. Do go to our website. We actually just relaunched our entire website yesterday. So premiersmi.com has gotten a whole new facelift. Go check out our long-term care page. You can learn more about the carriers that we're working with, including Thrivent. Give us a call. We'd love to talk to you more about Thrivent and how it could fit into your portfolio that you can offer to your clients. Craig, thank you so much.
Thank
You
you, Mandy. Thank you, everyone, for
are the
having me.
best. So much good information. We can't wait to share it even further out with our agents. And we look forward to having you back again sometime soon.
All right. Thank you so much. Enjoy the rest of your day, everyone.
All right, guys. Thank you, everyone.